For more on the markets and what the options and derivatives are saying, let's bring in Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. And this is episodic. This is going to be the current episode that's available on Peacock. It's not available on Peacock. Should be available on Peacock. Probably never going to be. At this point. Oh, well. Anyway, it is episodic with you, Amy. And at this point, I read what you're saying, and it makes me worry, even though you're not worried. So you say people are fully positioned. They've jumped into the pool. That would normally indicate some complacency, but you don't think that will mean we don't have a Santa Claus rally. We still have one.
We'll still have one.
Why, if it's so complacent and people are already in?
Yeah, I think two things. When we last spoke a couple weeks ago, we were kind of talking about how the positioning wasn't quite full yet because you did have the hedge fund community pre-positioned prior to the Trump victory, but really the long-only community was just waiting for the election to pass.
That's right.
And, to some degree, that's why I thought we'd continue this rally, which we have seen. There's a lot of other seasonal factors that are just determinative for the rest of the year, which is really only a few weeks, right? So I do think we still get that Santa Claus rally. However, when you look at options term structure, which is just a fancy way of saying when you look at the near term, the next month, versus the longer term, which in options is the next 3 months, there is a great deal of uncertainty. That term structure is very steep, which means there's a lot of concern from investors for the first quarter of next year. That's where potentially we could face a little bit of a reckoning to some of the policies that will actually be enacted once Trump goes into power.
So on both sides, on puts and calls, are both expensive 3 months out, or just puts?
It's mostly on the put wing, and so that helps us determine a little bit about sentiment. So if it was overall pricing was high, that would tell you perhaps just there's uncertainty in both directions. But when you actually see that put wing rising, that usually means there is this demand for protection. Now, the one thing I would say that's always a little tricky to suss out is whenever there is more to protect, the put wing goes up, right? You're not going to protect anything in a down 20% market, which is very different than when you've jumped in the pool, you're very long. So I do think that is a wrinkle. But even outside of that, we've seen this steady rise since August 5th, which is when we got that big volatility spike. And it really continues to this day. Even
though the VIX is really low still, right?
Yeah, VIX is really low. And I think this is one of the tricks about the options market that is a little bit deceiving, which is your spot VIX is really low, but VIX futures, so what the implied volatility is going forward, is actually higher. And so that goes back to what I was speaking about with term structure. The next few weeks, people are relatively complacent about. Probably they expect the Santa rally. But a few months out, when you look at both VIX term structure or the S&P, you start to see that uncertainty boiling ahead.
I like the idea of putting on some kind of spread. And your favorite hedge right now is in the oil. Pat, if we're going to drill, baby, drill, why are you bullish? Because you're talking call spreads. You think you're recommending those. Why?
Yeah, and it sounds a little weird, right? But bear with me. So one thing that I think, I was joking with my colleagues yesterday that martial law in South Korea was like not on any of our bingo cards.
No, that's what I said. Yeah.
But here we are, right? So, energy tends to be a very good geopolitical hedge. And the one thing that I think option markets and equity markets have an unbelievably difficult time pricing is these geopolitical risks. It could come from Russia, Ukraine. It could come from South Korea, although I wasn't anticipating that at all. It could come from France. And what do you see the highest correlation to? It doesn't actually tend to be equity markets. It tends to be commodity markets. So these energy proxies, XLE, XOP, XEG, that upside tends to be the most correlated to geopolitical moves. That's why I like it.
Interesting. And it could be, economic issue. I mean, who would have thought the Thai baht was going to be on it? Or remember Cyprus? There was a problem with the currency. Anything can cause a global contagion.
Exactly.
Yeah, it's really amazing. So at this point, the Santa Claus rally comes, in your view, but next year, all bets are off because of and you actually you're usually pretty technical. Fundamentally, there are some uncertainties regarding policies from the new administration.
Yeah, and then I guess one thing I forgot to mention was obviously we have a rates cut potentially coming in December. I think that's what the market is pricing. That'll keep the market's happy for a little bit longer. That'll keep, IWM, your small cap proxies, happy for a little bit longer. But I think the one thing that we continue to hear investors say is they think the markets are going to be okay because Trump uses the market as a gauge for his own success. And it's interesting how many times I've heard that sitting across from an investor. And the question is, if that doesn't become the case this administration and we don't follow the 2016 to 2020 playbook, how do we actually follow through from a market perspective on if tariffs are implemented and, frankly, what other countries do, which we can't control? And I think a lot of that investors just haven't faced yet.
But at 22 or 23 times earnings, what can a president really do to guarantee that he's going to have a rising stock market? I don't know if he can't do it like Jay Powell can do it.
Well, I think in his mind, potentially he can.
Because he can tell Jay Powell what to do?
Yeah, but that's exactly my point. And I do think those tails are something that have yet to be considered, or at least a little bit underpriced in the market right now for the exuberance that we've had kind of post-elections. People are still trying to suss through those sector-by-sector impacts. And that's why we see that term structure, again, much higher going into next year.
Can you tell anything from derivatives in the as far as interest rates go in the yield curve? What is that indicating at this point?
So right now, and that's looking at rates volatility, not equity volatility, but right now there continues to be, a probability that we'll see a cut in December, although that pricing, went from like very, very certain to a little bit less. And then for next year, I think the debate is where we're going to stop. And that's one thing our own rate strategists have said is going to be much more short and shallow than I think is being priced into the market. And to me, a lot of that is data point dependent. So that's going to be your payrolls, your consumer price indices. And so I think a lot of that, the volatility will start to shift as we head into those data points.
So there won't be a lot more rate cuts at this point? Is that what you just said?
And that is the view of Blakeman, who's our rate strategist. And so we follow their views in terms of what we think that means for volatility.
What about rate hikes?
Is higher. That could certainly be, down the line. I mean, not in the near term, but obviously that's
2025. We don't know. I mean, I guess it's possible.
I think that's the biggest swing from an economic perspective. Is it's much more short and shallow than the market is pricing, and what that means, obviously, for equities in the future.